Welcome to Money Chic, Financial Education with Shari Rash, the podcast that's here to empower you with the knowledge and skills you need to master your personal finances and live your best financial life. I'm really excited for our conversation today. Today, I am joined by Matt McCann. Matt is a nationally known speaker on long-term healthcare issues and is sought after by the media for his expertise. With over 20 years of experience helping thousands of clients nationwide, he has witnessed firsthand how long-term care insurance gets used at the time of claim. Matt recognizes the value of affordable long-term care insurance and its positive impact on American families. He is recognized by the American Association for Long-Term Care Insurance as one of the top specialists in the country. Matt is among the selected few specialists in the nation endorsed by the AALTCI. Matt McCann, thank you so much for joining us today.
Well, thank you for having me. It's great to talk about long-term care with anyone, especially you. I've heard so much about your podcast, so I'm glad to be here.
Thank you so much. So long-term care is a difficult subject to talk about, just like really any type of insurance is to talk about. It kind of makes us a little uncomfortable. We usually end conversations with more questions than answers. And honestly, it just makes us think about a point that we could reach in our lives that's not very desirable, being in a long-term care type situation.
And I think that's really the primary problem. The primary obstacle is the level of denial all of us have. The difference today than when I first started in the late 90s is that most of us are now aware that long-term care is not just a national issue, it's a global issue. The problem comes is whether it's going to impact me. So you're sitting there saying, yeah, I know long-term care is a big problem. Man, that guy across the street, man, he really needs to be worrying about this. But if you go across the street and talk to him, he's turning around and saying, man, that woman across the street, man, she really needs to be thinking about long-term care. She's got the problem. We're pointing at each other. And the reality is longevity is the big driver of long-term care. And it impacts all of us, not just from a financial standpoint, but from an emotional standpoint. And that's hard to think about. It's hard to deny about death. We're all going to die at some point.
Right.
But to think that we may need help with everyday living activities that we take for granted today, or maybe worse, having dementia or Alzheimer's, is something it's very difficult for us to internalize. And it's this denial that prevents a lot of people from thinking about it, much less doing anything about it.
And do you think that denial helps we start to lose it once we are in an experience where we have a family member or a friend with a family member, the mirror starts to be held up to? Is that what it takes for us to really realize, hey, we need to be thinking about this?
Sometimes it's that personal experience that really gets us motivated because we see firsthand the consequences of aging and declining health. Otherwise, it's just theoretical.
Right.
It's much easier to deny something that hasn't been experienced. The problem today is it's hard to run into anyone that is not experienced long-term care on some level. Now, a lot of times we don't recognize it as being long-term care. For instance, this past weekend, talking to a client who is helping their mom every day, going to their house, helping her in and out of the bathtub, and making sure she's got her medications. And she didn't really think about it as providing long-term care. And when I asked her, well, how long have you been doing this for your mom? About 2 or 3 years.
Wow.
And then the next question is, well, how has that impacted your life? And the laundry list of changes in this woman's life is tremendous. But she didn't realize, oh, this is long-term care. So sometimes you ask just a general question, have you experienced long-term care in your life? Oh, no, I don't know anyone when you start actually asking the questions, they have a lot of experience. They just didn't recognize it as being long-term care. And Sherry, the problem, of course, is everyone thinks long-term care is nursing home.
Right. Exactly.
And most long-term health care is not in a nursing home. And if any of your listeners listening right now learns anything about anything we say in the next few minutes, long-term care is not just about nursing home. It's about being as independent and in control of your life, usually in the comfort of your own home, or maybe adult daycare or assisted living. Certainly not a nursing home. Who wants to be in a nursing home? Certainly not me.
Yeah, absolutely. That is a mistake, is that we think long-term care, we think nursing home. Well, I don't know many people that ended up in a nursing home, but you're right. If someone is having to help you function or do those, like you said, those things that we do every day that we take for granted, that's a long-term care type situation. Someone is caring for you.
And if you don't have a friend or family member that is providing that care, someone has to. And
Right.
the cost of home care is certainly not cheap, and it's rising each and every year, much less assisted living and nursing homes, of course, are the most expensive. These costs, if they go on even a year or two, are substantial. If you need 3, 4, 5, 6, 7, 8 years of care, they can be really changing not only an individual or a couple's lifestyle, but changing their legacy as well.
And conversely, if you're not having someone, if you're not paying someone to care for you and someone's doing for quote unquote free, a child or what have you, it's still costing a lot because it's that time, it's potentially missed work opportunities or not working at all. So there still is a cost, even if someone is caring for you. And I would say a lot of households are dual income households. So just saying, well, my kids are going to take care of me or having a child, that's not as realistic in today's world.
Well, when you say your kids are going to take care of you, what does that really mean? And how will it change their lives and their responsibilities?
Yeah.
So let's face it, us guys are not generally caregivers. It's not that we can't do it, but caregiving is a woman's issue for the most part. So let's start with a couple. All right. If the husband needs care first, is typically is what happens. Something happens to the guy first. His spouse, usually a woman, not always, obviously, but usually, let's say it's a woman, is probably going to be in the same age. Even if it's the same gender, it's still going to be generally in the same age group.
Mm-hmm.
So if you need care at 80 and your spouse is 78, imagine a 78-year-old woman taking care of an 80-year-old man who's, let's say, 5'11", 210 pounds.
Right.
Not going to work really hard. Okay. So, all right. So the spouse, not really going to be a good caregiver. So now you go to adult children. Now, what are their ages? They may be in their 30s, 40s, 50s, or 60s. Okay. Well, even by the time you're in your 40s, you're no longer a spring chicken. You've got a career. You probably have a spouse. You probably have kids. You have responsibilities that go along with that. They don't disappear just because you're helping mom and dad. Okay, well, maybe you quit your job. All right, well, what happens, as you mentioned, to that income, that lifestyle? How fair is it to your spouse and your children? So if your kids are playing softball or basketball, or they're on the speech team and you want to be there, but you can't because you're being a caregiver,
Mm-hmm.
how it's going to affect you, but more importantly, how is it going to impact your kids?
Right. And that's making the assumption you all live in the same town or live within driving distance, right?
Absolutely, because that is not always the case.
That's right.
So the consequences, I like to use the word consequences. The consequences of long-term care are more than just about money. It's about family. And as we talked a little bit about before we went on the air, long-term care is a woman's issue. Because generally, women become the first caregivers, either as a spouse or a daughter or daughter-in-law. by the time a woman needs care herself, often she is now alone and she's the care recipient.
Mm-hmm.
And women still outlive us guys. And the other thing is women thrive in a caregiving environment longer than men do statistically. So when I talk about long-term care, I talk about it as sure, it impacts men, and men are taking better care of themselves. So they're living to longer ages as well. But it's a woman's issue.
Mm-hmm.
And if you're a couple, that's important. If you're a single woman, it's even more important because who do you have to rely on? And
That's
if
right.
you don't have kids, and I run into couples or individuals without children, you're going to depend on nieces and nephews. What
Right.
happens often is you're depending on your peers. Okay,
Mm-hmm.
so I run into this often, talking to a 50-some-year-old woman. She's single. Who's she hanging out with? Other women like herself, and they kind of start depending on each other as they get older. The problem is we're all getting older, and we want friends and family to remain being friends and family, not
Right.
having to rely on them to be caregivers. And there's a distinction being family and caregivers. And family and friend caregivers are untrained and typically unprepared for the huge physical, emotional, and financial burden that being a caregiver places on them.
Absolutely. So if as you're speaking with people, or if when I'm speaking with my clients, it's okay, I get it. There's a need. I don't want my kids to take care of me, or I'm going to be alone. I say to women, there's a 96% chance you're going to be solely responsible for your finances due to widow, divorce, or being single. So you're again relying on yourself, or you're going to be alone at some point, which is why long-term care is important. But it seems we get people's attention, but then when it comes down to, okay, let's talk about what this insurance, right? Because that's really you have two choices. You can insure yourself, or you can self-finance. And that's a fancy way of saying you pay for it out of your own pocket or out of your investments or anything like that. And then when we go through the process of, well, let's look at what insurance look like. There's sticker shock. It's holy mackerel. And then it's kind of like 3 steps backwards, where at first we had to do the work of holding the mirror up and saying, the likelihood of you going through this circumstance or whatever, okay, we accept it. But then we kind of go backwards and go, I'm going to take my chances again. That's a big number for me to pay each and every year for insurance.
Well, no one likes insurance. All right, come on. Nobody. I know if you watch TV and a lot of people, when we're recording, March Madness is going on. So everyone's watching, and there's lots of insurance companies, Nationwide, State Farm, fill in the blank. They got creative commercials. They're trying to make insurance fun. Guess what? You buy a new car, you're going to drive it around. You're going to show it off, right?
That's right.
Are you going to bring your long-term care policy to your lunch date with your friends?
No one's bragging about their insurance.
No, it's insurance. It is what that quote-unquote insurance does. It gives you the freedom and independence. So you mentioned something is important. A lot of people think long-term care insurance is expensive. So let's first start with, how much is the cost of care?
Right.
I use the LTC News cost of care calculator, which is on ltcnews.com. I think it's one of the most balanced and more realistic cost of care calculators in the industry. Even with that, cost of care, while it does vary dramatically from depending on where your location is and the type of service, is not cheap. Most care does start at home. Most home care starts 3, 4, 5 times a week for 4 or 5 hours and slowly progress, what we call progression of care. And then you might start adding adult daycare, or then decide, depending on the size of the house, sell the house and move to assisted living. And then base cost of assisted living plus surcharges start racketing it up. Care is expensive. So, okay, now you look, well, it's not going to happen to me. All right, well, we have homeowners insurance. Why? I mean, if you didn't have a mortgage, would you have homeowners insurance? Yeah, probably. I've never run into anyone that's not. Yet, how many people on your block have had their home destroyed by fire, tornado, aliens from Mars, earthquake? Probably none. Okay? It just doesn't happen. Statistically, I think it's like 1 out of 1,200. Doesn't happen. Okay? Yet we have homeowners insurance. Okay? You can't drive without auto insurance. The chance of totaling your vehicle is small. Okay? Even the chance of being in the hospital is a relatively small risk. But according to the Department of Health and Human Services, you reach the age of 65, you're flipping a coin. The question is really not if, it's when and how long. We don't know when, we don't know how long. If we did, planning would be super easy. So the cost of care is always going to generally be much more than the cost of any kind of insurance policy. Now, secondly, long-term care insurance for most people is actually very affordable. So why do people think it's expensive? And I'm not going to pick on financial advisors, but I'm going to pick on financial advisors. Here's what a typical financial advisor does. Okay, Mr. and Mrs. Smith, you live here in Kansas City, Missouri. The average nursing home is $12,112, so we need a policy that does blah, blah. No. You'd be dramatically overinsuring. Most care is not in a nursing home. And my general philosophy, A, is to take a catastrophic situation and make it manageable. You don't need to overinsure. You're going to have income. You're going to have, at minimum, Social Security. You're going to have some earnings off investments coming in. Maybe you're lucky enough to have a defined pension. So between your long-term care insurance and part of that Social Security should pay for most of your long-term care without changing lifestyle or having to spend down a lot of assets, okay? Secondly, premiums can vary dramatically between companies. I mean, and when I say dramatically, I mean dramatically for the exact same coverage. So a lot of financial advisors and general insurance agents may represent one company, maybe two. So that's all they have in their little portfolio. And people like myself represent all the major carriers. Every company has their own underwriting criteria and their own pricing strategy. So what people like me do, and there's other people, not just, I'm not the only one. There's other people like me. We learn about an individual based on their health and finances, what's important to them, where in the country they are, to make the proper recommendations. And most of my clients are in their 50s. Average age of my clients, 53. Now, I have older clients, but the premium, if you start off later, is going to be higher. But it's more than just that because of the underwriting. I think the American Association for Long-Term Care Insurance says if you reach the age of 65, the decline rate is, I think, 38, 39%. It's some large number. Now, that's a general industry figure. My decline rate's much lower because I know how underwriting works. But nonetheless, it just look at your life. And all of a sudden, you're 40, you're fine. Now you're 45, you got this cholesterol medication. Now you're on blood pressure medication. Now your knee hurts, your hip hurts. Now you're 55 and, you had your first colonoscopy and now you got this. It's aging. Okay. So premiums are based on age and health at the time of application. If you do it sooner than later and know how to design a plan appropriately, you can find very affordable coverage. There are various types of policies out there. You have traditional long-term care insurance, which includes all the partnership certified plans. Most states participate. Authorized under the Deficit Reduction Act of 2005, signed by President Bush at the time, allows states to participate and offer qualified long-term care insurance policies that provide additional dollar-for-dollar asset protection, or what a state bureaucrat would refer to as asset disregard. So in the event you were to exhaust all the money from a qualified partnership long-term care policy, to be able to legally shelter part of your estate based on the total amount of benefits paid out by the policy and still qualify for Medicaid. In other words, in a catastrophic, although less likely, long-term care situation, you're guaranteed never to lose everything. What it allows for is, even with someone with more modest savings and income, to have a long-term care policy, much more affordable, protect virtually everything they have without having to buy these huge policies that insurance agents and financial advisors tend to recommend to each and every person they talk to, which is dramatically overinsuring. There are hybrid policies. They are, quote unquote, popular from the insurance industry standpoint. The hybrids combine life insurance or an annuity with a qualified rider for long-term care. Now, it's important that not every one of those products meet federal guidelines under Section 7702B of U.S. Code. So you have to only stick with the products that meet federal guidelines. But because they include a death benefit, they're going to be more expensive. Are they appropriate in some circumstances? Absolutely. In some circumstances, absolutely not. I had just last week 2 clients that their financial advisors recommended these huge hybrid policies. Single pay, $150,000. One was $250,000. And I do their financials, and it's like, where's this money going to come from? You only have $400,000 in your IRA, your 401k. You can't put that kind of money into it. So I showed them a partnership certified traditional policy between the couple. It was $300 a month for both of them. They're happy. Their family's happy. I'm happy. And that's why I think when you, as a consumer, hear or read something, you've got to ask more questions. Is long-term care expensive? Long-term care is expensive. Is long-term care insurance expensive? It can be, but usually, no. Now, the oldest client ever got approved was an 85-year-old guy. He was 85 going on 35, and he had the health and the looks to back it up. He had a 38-year-old girlfriend, so you get the idea of where this guy was. And the girlfriend said, you got to have long-term care insurance. He didn't want anything to do with it, but he did. Not only did he not just get approved, he got approved preferred.
Wow.
But, he was paying $6,500 a year for a policy. But it made the girlfriend happy, so he was happy. So there you go. But everyone is different.
What do we say back? Because oftentimes I'll hear, well, I had a friend or I had a neighbor, family member, what have you, that had a policy, but it ended up not even covering close to what they thought it was, or the policy ended up changing and premiums going up. How do we work through that?
Well, first off, policies can't change. If they're a tax qualified long-term care policy under federal law, they can't change. Benefits are the benefits. Okay. Now there's policies out there that don't meet federal guidelines, and I don't deal with those products. But a tax qualified long-term care policy has the consumer protections, the regulated benefit triggers, and the tax incentives that are in place. The triggers are pretty clear cut. It is your healthcare professional that certifies that you need assistance with at least 2 of the 6 activities of daily living, or you require supervision due to a cognitive impairment. Now, when we talk about activities of daily living, it doesn't matter whether we need physical, hands-on assistance, or what they refer to as standby assistance. Standby assistance means you can still do things on your own, but your doctor says you really need someone there to stand by just in case. That's the trigger. Okay. Now, what happens sometimes is I had a guy a few years ago call me, wanted to make a claim. His wife passed away. And he goes, I need to go into assisted living. Okay. All right. Well, what's going on with your health? There was nothing wrong with him. He played golf every day. So why are you calling me, Fred? Well, I can't cook or clean, do laundry. I can't do any of that stuff. Well, is there something wrong with you? Well, no. Ethel did that my entire life. He needed a maid or a girlfriend. Okay. He didn't need long-term care.
Right.
There was nothing wrong with him. Okay. So I think as a policyholder, and sometimes this is the insurance agent's fault because they didn't describe the policy. And of course, when you buy the policy, you may not need it for 10, 15, 20, 25, 30 years down the road. Right. So you can remember what the insurance agent or financial advisor said? Probably not.
Right.
So their expectations may have changed. Okay. As far as premiums are intended to remain level. Now, there's lots of good intentions in the world, and the road to good intentions leads to you know where. Okay. However, the old legacy products sold before rate stabilization rules were in effect, and more importantly, before the interest rate crash, they were never priced to withstand a interest rate environment this low for this long. Interest rates and long-term care insurance are important because most of the reserve funds have to be in federal bonds and things like that, in which obviously the insurance companies' returns were nowhere close to what actuaries expected. Okay? No one expected. The last time we had an interest rate crash this low for this long was in the 1600s. Okay? And it didn't last that long, okay, as long as what we've gone through. And they're still relatively historically low, even though they've gone up a little bit. Mm-hmm. So they made a mistake with that. They did underprice the product back in the day. They also sold a lot of unlimited, meaning you can never exhaust the benefit, with 5% compound inflation policies. Well, if you have to promise 5% return with your benefits, and all of a sudden the interest rates crash, and you don't have a way to maneuver investing the money because you're limited because of federal regulation, that's a problem. Okay. Mm-hmm. And then you add that underwriting in those days were not as sophisticated as they are today. It's a perfect storm. It's no one's quote unquote fault. It is what it is. Yet, despite that, very few of my clients ever paid a higher premium because they were able to reduce the inflation rate or the benefits a little bit to keep the premium, if not the same, very close to the same. What you read about on the internet, God forbid, or hear horror stories are those weird situations where someone had a really, really huge policy, probably much more than they had. Now all of a sudden the premium went to $9,000 a year and no one ever told them that they can reduce the benefit and keep the premium the same. So you have to ask more questions. Today, well, the Society of Actuaries says the chance of future rate increases is like less than 10%. The point is, even with increases on the old products, the value of the benefits these individuals have compared to the risk of needing them is huge. Mm-hmm. So I talk to these people that, have, if not unlimited benefits, huge benefits. They got, in those days, it was mostly a daily benefit. They got $300-400 a day, much more than what they actually ever need. Unlimited, or they got 800 a million plus in long-term tax-free long-term care benefits. And you look at what they're paying for it, even with the increase, it's still a value. So at least today, you can expect more rate stability. There is much more regulation. There are more choices. So I don't see that as an issue, but you have to talk to someone who understands all this. So you're not relying on the neighbor's friend's cousin's wife relaying a story which you really don't know the details on.
Right. So when I'm working with younger clients, especially those that are, you get your first job and you're working, and it kind of sounds crazy that when you get your first job, you need to start planning for retirement. It's like, whoa, wait a minute. I just started working. I have to plan to retire. It also sounds like when it comes to the long-term care world, hey, I'm in my 40s. I'm hitting the prime of my life. Now let's start planning for when you're not in that phase, right? I mean, does that sound about right?
Yep. Well, here's the thing, okay? And you're right. We start planning for retirement with our first job, okay? Um, and I did an okay job at doing that, but it took me a while to start taking advantage of the 401k. I was, 20 some years old. You're going to take how much out for what? I
Right.
wish I did. But I've caught up, but you don't plan for retirement 2 years before you retire
Right.
or 2 years after you retire, right? You
Yes.
plan way ahead. And you can't depend on Social Security. That was never meant to be a retirement plan. The word supplemental is in the name. Okay. It's supplemental. And if you're young, I'm probably the last people that'll have Social Security the way we know it because I was born in 1960. So, the people younger here are not going to get the same benefits as the people that are just getting ready to get into Social Security in the next couple of years. So you have to plan. And when is the best time to plan? The problem planning real young for long-term care is the other responsibilities that you happen to have.
Right.
Okay? You've got your jobs, you're having kids, you're buying houses, saving for college.
Mm-hmm.
Maybe you want to take a vacation. And last time I heard there's only 100 pennies in a dollar, right?
Mm-hmm.
So you're telling me I have to pay more long-term care too?
Right.
Well, there are a handful of states that are now considering the so-called LTC tax, which will tax individuals age 18 and older that do not have a qualified long-term care policy in place. State of Washington was the
Wow.
first one. Now, they don't call it a tax. They call their program Washington Cares because they care so much. But what it is, and the reason they don't call it a tax is because they call it a benefit. Okay, you get $36,500 in long-term care benefits. Whoop-de-doo. I'm sorry, that's not in the state of Washington, one of the most expensive places in the country for long-term care. Maybe better than nothing,
Yeah.
but it's not really a long-term care plan. And the state themselves were misleading the public on what it was. And part of the state were state agencies that were debating each other, which was really hilarious to see. And now they may scrap the whole thing, but you got California, Minnesota, New York, Illinois, Michigan, a number of states, Pennsylvania that are looking at similar ways. And what they want to do is find ways to get more money into Medicaid. Long-term care is the biggest line item for Medicaid. It's expensive. And the reason we're talking is a lot of people don't want to think about long-term care, much less plan on it.
Right.
So they're looking for money. It's easier to, add another tax, and that's the route they're going. So if you're fairly high income, these taxes are expensive. But there are ways, especially if you're lucky enough to have fairly good income. There are a number of companies that allow you to pay off a policy in 10 years. So by the time you're retired, while you're paying a higher premium during those years, premium disappears. There are ways to deal with it. But realistically, I think once you're in your mid 40s, unless you're in a state that's considering the tax, or you have strong family history that you want to deal with it while you are healthy and not having those issues, is an appropriate time to start planning for the cost and burdens of aging. And because the premiums can be so affordable if designed appropriately, why wouldn't you? And there are tax incentives. If you're self-employed, have a C Corp, S Corp, LLC, whatever, you can deduct the premium. Proceeds are always tax-free. There are a lot of ways to plan. And that's why you have to start having that conversation.
Mm-hmm.
Conversation may be, let's wait a little bit. Or the conversation is, hey, let's divert this to this and take care of it. But is having the conversation is the first thing to have. That opens the door to planning.
Yeah. Acceptance of the fact of, I'm going to have this conversation. This is realistic. The statistics show that I could end up, or my spouse or partner could be in this situation. Accept it, have the conversation.
The other thing is long-term care can happen at any time.
Right.
I have several clients very young with early onset Alzheimer's.
Mm.
I've had people with MS, Parkinson's, motorcycle accidents. So you do not have to be old to need long-term care. And your health insurance, Medicare supplements, they're only going to pay for short-term skilled care. That's it. Most long-term care is custodial in nature, and that's help with activities of daily living, supervision due to a cognitive impairment. And it's only long-term care insurance or Medicaid that's going to pay for that. Medicaid requires you to have little income and assets. So unless you're already there, that's not a solution. So it's that being realistic that long-term care is a reality. Health can change at any time, and long-term care can happen at any time. And the other thing that's really impacting people today is you don't have to be sick to need long-term care. You could be just old and frail, healthy on paper.
Right.
Oh yeah, there's nothing wrong with me. But you're 88 years old. You're 92 years old. You need that standby assistance. And if you have to need long-term care, that's probably the ideal reason to need care is because you're an old fart. There's lots of moving parts, but the basics are really simple. Okay. You qualify for benefits. It's a defined trigger outlined by federal rules that every state agrees with. Every tax qualified policy has to have the same benefit triggers. You decide how much money you want, and they'll pay up to that amount. It could be inflation, which you probably should have, depending on your age. And you have a pool of money or an unlimited pool of money. And you don't have to make it more complicated than that. Policies do a whole lot more, including case management, all that kind of stuff. But let's bring it down to the basics. Let's be brilliant at the basics and expand from there. And at that point, it becomes, oh, okay, I get it. It's pretty simple.
Mm-hmm. Now, we talked about when we should really realistically start thinking about it in a perfect world. Does that always happen? No, it does not. I mean, when you're in your 40s, you're, like you said, paying for college, just finally feeling like you're on steady footing, right? It certainly, with my clients, becomes more of a conversation 50s, 60s. When, I don't want to say too late, but when do we kind of miss the boat or
it's too late when you start needing care.
Yeah. Okay.
Then it is too late.
Right.
Otherwise, it's never too late as long as you have health. It's your relative good health today that gives you the opportunity to plan. Now, there's a variety of ways and strategies you can go about it. I have more and more parents, elderly parents of my clients who are in their 50s, purchase long-term care insurance for their kids because they're taking the required distributions.
Mm-hmm.
Okay. So the strategy is, well, why am I going to hang on to this and continue to be taxed on it? And the kids don't get benefit until I'm dead.
Mm-hmm.
Take some of those required distributions, apply it to my kids' long-term care insurance.
Which is really a gift for their grandkids, who they probably like better than their kids anyway.
Absolutely. It's like, okay. And you're not talking about a huge amount of costs. I mean, okay, maybe you have 8 kids, but so you got to look at where is the money. So if you're a couple in your 50s and your mom and dad are doing pretty well, there's a conversation to be had. Especially if mom and dad did not plan for long-term care and they're going to be depending on you to help. The trade-off might be, okay, why don't you take some of those required distributions and apply it to my long-term care insurance to protect your grandkids?
Mm-hmm. How often do you see adult children, taking out policies or paying for the policies for their parents? Because if to our earlier conversation of how, one, if you work and leaving your job to care for a parent isn't realistic, you don't live in the area, the adult child may say, well, this is a way that I can help care for my parents by paying for their policy. How often do you see that? What's that conversation like?
It comes up often it's executed less.
Why do you think that
And it's
is?
executed less because they're talking about it because mom and dad are already having failing health. Okay?
Mm,
I do have at least 4, 5, 6 times a year where the adult children are paying for a mom or dad's long-term care policy, primarily because they don't have a lot of money, meaning the parents don't, but they don't want mom or dad to go through the Medicaid system. Okay, so they chip in by a long-term care policy. Mom might be 72, dad 72, so they're still insurable. They have health, um, but it wouldn't have been appropriate for them on their own to buy the policy. That happens, but usually that conversation comes up because mom and dad are already having failing health.
mm-hmm,
So it's already too late.
mm-hmm.
And it comes back down to having the conversation.
Right.
You need to have a conversation with your older parents, see what their preferences are, see if they do have a plan in place. Sometimes the adult children don't know that they bought long-term care insurance and it exists. Find out what their preferences are. Not just about long-term care, but all the end-of-life stuff that comes up. At the same time, it's a good time to have that conversation for yourself. Okay? And maybe you're not going to discuss this with your 12-year-old daughter. But the point is to have that open conversation. One of the biggest times for long-term care insurance are the holidays, leading up to Thanksgiving through after the first of the year. And I think there's a number of reasons for that. People are together. And now the COVID years were a little weird, but aside from that, people are together. They start seeing Aunt Rose over here. Man, she's really changed in the last year and all that kind of stuff. All that conversation comes up. And one of the biggest claims for long-term care insurance periods is this time of year for the exact same reason.
Oh,
You might talk to mom and dad on the phone a lot, but if they live far away, you're not seeing them on a daily basis.
right.
All of a sudden you go in for Thanksgiving or they come to you and it's like, oh.
Yeah.
So it's always best to start talking before the crisis starts. What we're trying to do is avoid a family crisis.
Mm-hmm.
And that's what it is.
Yeah.
When there's no planning involved and someone needs care, now you're in crisis mode. And the best decisions are normally not made during a crisis.
Right.
So think of it, if there's a plan in place, you know what to do, how to do it, and that allows you to have more time to be loving and supporting, as opposed to running around trying to figure out what
Right.
are we going to do next.
Absolutely. That's a great note to end on. And, I one time a colleague, a financial advisor who has been a mentor to me, he said when he talks about long-term care insurance and they say, well, what if I end up paying for nothing and I don't use it? That's the best case scenario, right?
I mean, yes.
You won.
I mean, it really is. It's like, what kind of insurance do you buy that you can't wait to use? I mean, you don't want to get in a car accident. You don't want your house to burn down. Well, sometimes you may want your house to burn down, but generally speaking, you don't want that to happen. You don't want to fall and get hurt and not being able to go to work. I mean, you don't want these things to happen. Okay. So if I tell you you're going to live a long, happy life, die in your sleep with a smile on your face without needing a day of care, isn't that a win?
That's a win. That's a
huge win. Where not planning, because there's only 2 mistakes you can make. Either have a policy and never need care,
mm-hmm.
or you don't have a policy and need care.
Right.
But if you have a policy and need care, well, hey, that's a win, right?
Mm-hmm.
If you don't have a policy and you never need care, well, I guess that's a win. But I say there's multiple wins here. If you have a policy and never need care, that meant you were fully mobile and independent and lived a long, happy life. That's a pretty good trade-off, right?
That's right. Absolutely.
I mean, no one ever complains about paying for homeowners insurance or auto insurance their entire lives and never having a claim. I really don't get, and I hear this all the time. what if I never need it? Well, do you really want to need care? Is that what you're telling me? You really want that? No. You got the health insurance in your back pocket, but you don't want to have surgery, right?
Right.
But the consequences of not being prepared don't just impact you. Impact your family, physically, emotionally, and financially. Planning takes care of that. And that gives peace of mind. And ultimately, isn't that what we want?
Absolutely. Matt, where can everyone find you if they want to learn more information?
Probably the easiest way, because it's easier to remember than trying to spell McCann with all the C's and the N's and the A's, is go to radioltc.com. That's radioltc.com. That takes you directly to my website. There's lots of material there, my contact information, phone, email, whatever. There's good reference websites out there. The federal government has longtermcare.gov. I also use LTC News, which is ltcnews.com. These are all good reference places. Whether you talk to me or someone else, make sure that you talk to someone who's a long-term care specialist, represents multiple carriers, that's processed claims, and understands underwriting.
Thank you so much for joining me today on Money Chic, Financial Education with Shari Rash. And if you'd like to learn more, please visit greenwaywealthadvisory.com to learn more about me and my firm. Thanks, Matt McCann, so much for joining me today, and we'll catch you next time. Ever wondered how to secure your financial future? Introducing Financial Foundations, the ultimate financial planning program. Take control of your money, plan for the future, and build a secure financial foundation. Join us on a journey to financial freedom. Visit greenwaywealthadvisory.com today to start your path to a brighter financial future.